what? All right, so reporting and paying payroll taxes. We've got two different schedules for reporting the taxes versus paying the taxes. So reporting the taxes are for the Social Security, Medicare taxes, and the amount of income taxes that were withheld. We've got the 941s. Remember, we do those on a quarterly basis. This reports the federal income taxes withheld, Social Security, both the employer and employee portion. It reports Medicare taxes and any additional Medicare taxes. It also reports wages, tips, and other compensation, which would include, bonuses, that kind of stuff. This is filed on a quarterly basis, with due dates being the last day of the month following the quarter. So April 30th, June, July 31st, we have October 31st, and January 31st. So first quarter, second quarter, third quarter, fourth quarter is when they are filed. Deposits, if you recall, are on a different schedule. Usually, if an employer's total payroll taxes are under, remember, it's all based on how much in payroll taxes the employer has. So if the employer, the higher the tax that's owed, the faster they want their money, right? So the payroll taxes may be due on a quarterly basis, but only if the amount the employer owes fits within the guidelines. So, let's see. Employers always start out depositing on a monthly basis. When it's on a monthly basis, it is due by the 15th of the following month. The deposit is due by the 15th of the following month. So we're in November, all wages earned in November. We'll have the taxes, federal income taxes, Social Security, Medicare taxes, additional Medicare taxes will have to be deposited for the month of November by December 15th, okay? That's if the employer's on a monthly deposit schedule. Now, like I said, there could be a quarterly deposit schedule if the amount is, if they owed less than $2,500, if they owe in the current period and the previous period. If they owed over $2,500, but less than, well, I'm kind of jumping around here. I apologize. How do I want to say this? I'll talk about this, the look back period first. Do you all recall the look back period? So the IRS is going to look back at the amount of taxes that were paid and due during a look back period, which runs from July 1st through June 30th. They're going to look at the taxes that were paid during that time, and if the total amount of taxes, which would include all of these, and both the employee and employer portion of both of these taxes, if it was $50,000 or less, then the employer is a monthly scheduled depositor. If it was $50,000 or more, however, they are what's called a semi-weekly depositor. We'll go through that schedule real quick. If you guys recall, that's the deposit schedule where the employer is not paying twice a week, even though it says semi-weekly. The IRS is receiving payments on 2 days during the week, and it all depends on when the employer made had their payday during that time. So again, this look back period, if it's less than $50,000, then it's going to be monthly. If it's greater than, is it greater than or equal? 50,000 or less. Greater than 50,000, semi-monthly. I'm sorry, semi-weekly. If it's greater than 100,000 during, and this is not during the look back period, greater than 100,000 during one pay period, then it's next day. Okay, so for these two, we're looking at the look back period. For this one, we're looking at one particular pay period. So any employer that has a next day deposit requirement is going to be a monthly or a semi-weekly depositor normally. And they could even be a quarterly depositor. It's kind of rare to go from only owing 2,500 to owing over 100,000. But this is a temporary deposit schedule. If you don't exceed the 100,000, you don't have to pay by the next day. And it's by the end of the next business day that it's required. Monthly, remember, so this is by the 15th of the following month. Semi-weekly is either going to be, the deposit is either going to be due on Wednesday or Friday. One of those days. And it depends upon when you had your payday. So if you had your payday, I have it listed here, 15th day, there we go. So payroll taxes associated with payrolls on a Wednesday, Thursday, or Friday. Go over here, I'm gonna erase this. So for semi-weekly, so payday, Wednesday, Thursday, or Friday, then the deposit has to be made by Wednesday, the following Wednesday. If the payday is Saturday, Sunday, Monday, or Tuesday, then the deposit is, I should say, the next Wednesday. Next Friday. So it all depends on when that payday is, when the amount has to be deposited. So like I said, it doesn't mean that the employer has to make 2 payments during the week. It's kind of the wording on it is a little bit funny, because when we're talking about a monthly deposit schedule, we're saying we deposit monthly. When we're talking about a next day deposit schedule, we're saying that we deposit next day. But when we're talking about a semi-weekly deposit schedule, it does not mean that we deposit on a semi-weekly basis. It means the IRS is going to receive those payments either on Wednesday or Friday, based upon when that payday is. Okay, that make sense? Questions? Let's see, what else do I want to say here? It's based on, and it's when the payroll is paid, not the end of the payroll period. So whenever that pay date is, because that's at the point at which the liability is incurred. Always with every IRS deadline, if the deadline is on a weekend or a holiday, then it's due the next business day. So we've got Elemento company, they pay employees on Friday. Monday is, oh, I don't need it. Monday's a banking holiday, then they would, if they were on a, let's see, so they pay on a Friday, so they have to make the deposit by Wednesday, even though Monday is a banking holiday, they don't get an extra day then. It's only if that due date falls on a holiday. Employers with payroll tax liability of less than $2,500 at the end of any quarter can pay that using when they file the 941. Okay? $100,000 or more during any pay period, then, and again, this is not wages, we're talking about payroll taxes, right? So sometimes it's easy to get those two confused. If the payroll tax liability for any one pay period exceeds $100,000, then that deposit is due by the end of the next business day. It seems like a lot of money, but if you think about big organizations, they would be paying every single Amazon, Walmart, Target, you know, all those places, probably DMAC, are paying by the end of the next business day, right? Because there's enough that's accumulated. If though, again, this only applies to that payday. So if the next payday they owe $90,000, they're going to go back to their regular schedule, whatever that schedule was. So that's a one-off. The $100,000 is a one-off, but for a lot of companies, larger companies, they would be regularly paying by the next day. Lots of penalties. Penalties for late payment. The later you are, the more the penalty is. It racks up. Payments for if electronic deposit is required but is not used. Most companies now will require electronic deposit. If you write a check though, they'll penalize you for that. So late payments, late returns as well, and oftentimes they will assess interest as well as those penalties. Let's see. So employers who withhold taxes from employee paychecks are holding the withheld taxes in trust for the employee a lot. There are a lot of employers out there that make the mistake of borrowing from the taxes that they have withheld from employee paychecks, and they get themselves into a lot of trouble for doing that. If they don't make those payments, as you saw, there are lots of penalties. Sometimes they can't ultimately make those payments if they've borrowed those funds. They'll, pull them for operations or for something else. They can get into a lot of trouble. It's not their money. For companies, they really should have a completely separate bank account for any taxes that are withheld. It should just be completely separate from anything else, because that is not their money. It's held in trust for the IRS and for the employees. That's why the IRS goes after companies that violate this. So owners, even if it's a corporation, owners are personally responsible for payroll taxes. So if those payroll taxes are not paid by the company, the IRS will go after the assets of the owners in that case. Okay, let's see. We talked about the 941, a little bit at least about the due dates for the 941. I talk a lot about this COBRA. Do you have any homework questions on the COBRA stuff? This was like, some of this was really special for COVID. So I'm not really gonna go over it. Let's see. All right. You recall, this is what the 941 looks like. We've checked the box that corresponds to the correct quarter. They want to know the number of employees who received wages, tips, or other compensation during a particular pay period during that quarter. Total amount of wages, this would be federal taxable wages. Okay, so this total for each of the quarters, for all 4 quarters of the 941, needs to match the total in box 1, the sum of all the totals in box 1 of the W-2s, and also what's on box 1 of the W-3. That is one thing that has to happen. So these are federally taxable wages, so they wouldn't include like pre-tax deductions, that sort of thing, or non-taxable payments. Federal income taxes that were withheld, total for the quarter, Social Security wages that were subject to Social Security. So again, this could be different based on, because if you recall, we have certain benefits that are pre-tax for income tax purposes and other benefits that are not pre-tax for Social Security and Medicare tax purposes. For example, retirement contributions. If an employee contributes to a retirement plan, this is going to be, I'll give you an example here. So if you've got an employee with gross wages of, say, $1,000, and they contribute to a 401k, $100 per pay period. Their taxable wages for federal income tax purposes, federal income tax, we'll call that wages, would be $900, because they get to reduce that 1,000 by the 100. But for Social Security and Medicare, they don't. It's going to be based on the full 1,000. So these boxes could and oftentimes are different. Also, the Medicare wages, of course, could be different because this amount, remember, Social Security wages are capped at $147,000 per employee. So if there were amounts that were paid to employees that brought them over that $147,000, that is not going to be included here, but it's going to be included here. Whoops. It's going to be included here. So these three, box 5A, 5C, and 2, can be and oftentimes are different. All right. So you can read the instructions here. So these are just the totals, total of Social Security and Medicare taxes that were, and this is both the employer and employees portion. And then this would be the total of Social Security, Medicare taxes, and the amounts that were withheld for federal income tax purposes. Remember the adjustments for fractions of cents? This one usually gives payroll students headaches. This particular line I'm talking about here, line 7. Do you guys remember that? When you have a rounding difference, so remember when you're making the deposits, you are, well, I shouldn't say the deposits. When you are calculating the Social Security taxes and Medicare taxes on an individual level, and then you add all of that up, you're very likely going to come up with a slightly different amount than when you are calculating all of those wages together, right? This line is to make that adjustment, to make that work, so that the amount of that you owe is exactly the amount that's shown on this form, right? So that could be plus a few cents, it could be minus a few cents. So it's just to account for rounding. Let's see, what do I want to say? This part here, part 2, if you're a quarterly depositor, you would check this box, so you owed less than $2,500. If you were a monthly depositor, you would check this box and indicate what your liability was, not what your deposits were, but what your liability was for each of those months. If you were a semi-weekly depositor, you would check this. Or it should say also, if you had any payday that where you had $100,000 or more, you would do that. This is page 3, 4. This is Schedule B. So this is for semi-weekly depositors or for any particular pay period where there was more than $100,000 liability. You would use the Schedule B. These dates again, so all of these, you've got 3 months here. Month 1, 2, 3 for each of the quarters. In this case, it'd be January, February, March. These are the pay dates. These are the days of the liability. Not when the deposit is made, but when the liability is incurred. IRS knows the day it was deposited. They have that record. They want to know when you incurred and they will use this to determine whether or not you were late with payment. So if you had a liability of $11,650 on the 15th, but you didn't pay it until the 30th, you're going to get a notice and a penalty. All of these. So this In this case, they've got exactly the same pay, each payday, looks like they're paid twice a month. Totals are here, and all of that. Okay. That's the 940 month. Again, I'm going through this fast because I know that most of you have already done all of this with payroll, but if you have any questions, let me know. I kept you over 4 minutes, sorry. Oh,